credit profile. It could be your paperwork. So I talk about this a lot when it comes to documents, tax returns, profit and loss statements. So a lot of these favorable or positive data points is what enables consumers on the business side to be able to get access to business credit. So that could be business credit cards, loans, lines of credit, business vehicle loans, whatever the case is. So you have to bring something to the table in terms of favorable data points. Now, in most cases, let's say if you don't have the cash flow or the revenue, then you should have good personal credit. Let's say if you don't have good personal credit, then you are going to need to have some type of cash flow. And there can be cases where you don't necessarily have the cash flow currently, but maybe on paper you have a good profit and loss statement and revenue showing on your business tax returns, and you have good personal credit. There's a lot that you can do with that, right? But the whole point I want to make is that you have to have some type of favorable data points. And what I see is that people who are basically applying to credit prematurely without doing any type of due diligence on what the requirements are. And that's really the main thing when it comes to getting approvals, right? Or increasing your chances of getting approval. It doesn't mean that if you have certain data points that you're going to get approved everywhere, but at least if you do your due diligence beforehand and understand all the requirements before you apply, you can avoid unnecessary denials, right? So anyways, without getting off topic, we're going to be going over some of the top business credit funders, and let's just dive right into it, right? So right here, I've pulled up a list that I came up with. And again, this is from just my anecdotal observations. And a lot of these companies and banks I actually work with directly. So I do get a sense of a lot of people who are getting approved for a lot of these different products. And so just starting out, I just wanted to go over the different types of business credit providers, right? So in general, you have direct lenders, you have brokers, and then you could also have companies that are direct lenders and brokers. So for those who don't know the difference between a direct lender and a broker, I'll give you guys some examples. So a direct lender basically is lending out their own funds. So this could be a credit union, a bank, or it could be a private lender that has their own pool of funds that they're actually lending out and underwriting. Then you also have brokers. So brokers are going to be, for example, the Rock Financials or the National Business Capital. I'll go over a couple others as well. But these are basically companies that work with direct lenders, and they're more or less able to match you with the best direct lender that meets your criteria, right? Or matches your data points. Now, there is some trade-offs with both, right? Is one better than the other? I think it all depends. So with direct lenders, they have very narrow credit boxes, meaning that if you don't qualify with the particular direct lender, they're not going to go out of their way to try to, tell you what qualifications you need in order to qualify, right? They're going to look at your data points. They're going to look at their underwriting checklist. And if you don't qualify based on their underwriting standards, you're just getting denied and they're going to move on to the next application. Whereas a broker, they'll basically come up with multiple different scenarios, multiple different options for you. So if it doesn't work out with one of the direct lenders, then they have maybe an alternative or several alternatives that you can go to. Now, I will say this in terms of loan approvals and conversion rates. You're going to see higher conversion rates working with brokers versus working with direct lenders. Because again, direct lenders more or less cherry pick the deals that they're going to approve, whereas the brokers are actually going to try to fit a business profile into a lender where they can get that approval. So you're more likely to get approved for funding through a broker versus a direct lender. And again, direct lenders have very narrow criteria. I'll give you an example. For example, ARF Financial, right? Or Ideal Financial, where they offer working lines of credit, working capital, business term loans. So some of these direct lenders might only work with specific business types. So if you don't fit into that business type, doesn't matter if you have good credit, good financials, they're not going to approve you because they have a specific business model that they have to adhere to. So a lot of times with direct lenders, they have very low conversion rates, right? Whereas brokers, you're going to be more likely to find some type of deal that's going to work for that borrower. So that's just a difference between direct lenders and brokers. But going back here, so let's just jump straight into it. So first on the list, we have Jumpstart Finance, right? Otherwise known as unsecured funding source. So they are specifically for acquisition entrepreneurship, right? So this isn't necessarily a company, or I'll say this, at least the Jumpstart loan. So this is going to be specifically if you're looking to acquire a new business or if you're looking to open up a franchise, right? Acquisition entrepreneurship, that's really what they're specializing for. So they have what's called the Jumpstart loan. And this is a direct lender, but they also are a broker. So again, just going back to the sheet, there are some companies, some lenders who are both a direct lender and a broker. So with the direct lending, again, they're going to cherry pick the deals that they want to fund. Now, usually if you don't fit the direct lending side of things, they'll just send you out to their third party marketplace, right? And so that's pretty much how they work, right? A lot of times with direct lending, they're cherry picking. But anyways, Jumpstart, I would say, is going to be geared more so for higher credit profiles, right? So they're not really working with subprime borrowers. Just to give you an overview, they offer 10-year notes or 5 to 10-year term loans. And again, they kind of fit in where the SBA kind of falls short. So for those who are aware, like SBA 7A, they're usually looking for loan amounts over that $500,000 mark, right? So a lot of times when you're trying to apply for a 7A, a lot of banks that work with SBA programs, for 7A, they want larger loan amounts, right? So if you're trying to get 150,000, 200,000, it's usually going to be harder for the 7A program. So that's where the Jumpstart loan fits in. And they actually can close a lot faster than SBA. So their sweet spot is between 50,000 and 250,000, terms from 5 years out to 10 years. So between 60 and 120 months. No personal real estate or other collateral required. So when you do like a SBA 7A, they also will ask for a personal guarantee. So in a lot of cases, you might even have to pledge your owner occupied residence as collateral in case of default. Another great thing about the Jumpstart loan is that it does not report to personal credit. So again, this is more or less like a hidden trade line, and it doesn't report to business credit either. So they have interest only and deferred payments for qualified borrowers. They also work with pre-revenue startups. So this could be like a new franchise, right? So again, this is more so for acquisition entrepreneurship. So if you're looking to open up a franchise, so first unit franchisees, and they work with existing business acquisitions or franchise resales. So essentially they want some type of proven business model. So this isn't really for if you're just trying to get a loan for your existing business, at least the Jumpstart loan. Okay. So they have other loan programs as well. But again, this is going to be more so for, their marketplace. So this is going to be for their brokers, not direct lending. So they only direct lend their internal funds through the Jumpstart loan. And I'm really close with the owner, Grant Ferguson, who's doing a lot of innovative stuff over at Jumpstart. And they have a lot of great products in the pipeline as well. Now, in terms of the requirements for the Jumpstart loan, you need to have excellent credit, right? So 750 is the minimum credit score. They're going to do a soft pull on your Experian if you do decide to do a pre-qualification. So they just do a soft pull to make sure you fit that requirement. Low debt to income, excellent payment history, personal liquidity greater than 50K. Current income, so W-2, 1099, and this can include household or co-borrower income. So you can use household income to qualify. So if there's more than one, income household, then, you could use that as part of the application. And it must be a registered business. So again, it doesn't have to be generating any revenue. So let's say if you just opened up a franchise or you signed a franchise agreement, it's not generating revenue yet. You can still apply, right? The cool thing about this program is that the qualifications are not predicated on business tax returns or profit and loss unless it's an existing business acquisition. So if it's a new franchise, you're not going to need business tax returns. You're not going to need profit and loss statements, but you will need to provide personal tax statements and also W-2 information. So with Jumpstart, this is pretty much, I would say, for, let's say, you're someone who's worked in your career already and you want to make that transition to entrepreneurship and you're looking to get into a proven business model. This is a good program because, again, the qualifications are going to be dictated by the strength of your personal profile. So personal credit and personal income. Business credit does not matter. Business tax returns, profit and loss do not matter. It's going to be mostly predicated on the personal profile of the beneficial owner of the business. So I think this is a really good option, especially for those who are looking to get into, let's say, franchising or existing business acquisitions. Now, one thing I also wanted to just go over real quick, because, I get a lot of, people talking about, well, why would you borrow money, right? So there's this whole, I guess, just mindset about borrowing money where it's kind of frowned upon, right? So I wanted to actually make an argument on why, in a lot of cases, it could make sense to borrow money instead of using your own funds. So right here, there's actually some summary information on the Jumpstart, loan portfolio, right? So the average loan amount, and again, this is just looking across the portfolio, $167,000, interest rate 13% on a 10-year note. And then the average credit scores, as you can see, is hovering in the high 7s to low 800s. Post-closing debt to income, 39%. Household income, about $242,000, net worth about $918,000, and average household liquidity, $372,000. Now, as you can see, when you look at the average household liquidity versus the average loan amount, it's much lower, right? Over almost $100,000 more. So essentially what this means is that on average, borrowers have more liquidity than what the loan amount is. And oftentimes people say, well, if you have the money for a business, why don't you just cash out everything? Don't even take out a loan. And this is something that I've seen where a lot of times when people actually do have the money, they'd rather have their money sit, let's say, in a CD or a money market account, and just have their funds in case of an emergency, or if they have to backstop a loan. Let's say the business venture fails, all they would do is just use their actual funds to repay the loan. But in a lot of these cases, since we're working with existing businesses with proven business models or franchises that have historical information on performance and revenue, and a lot of these businesses are actually turning a profit, so they're able to service the debt, repay the debt, and still make a profit, then in that case, it makes sense to leverage credit instead of using your own funds. And also, there's, I guess, a cost of having that peace of mind of having your money or your capital sitting in the bank, right? Or sitting in a different type of investment. Maybe it's a money market or CD account, right? So as long as the business is able to service the debt, then I don't see any problem with leveraging debt, right? And keeping your money however you want to keep it, right? I'll give you another example. Some of you remember a couple years ago, I bought a Hyundai, for a business vehicle, right? It was $54,000. And, a lot of people would say, well, why didn't you just cash it out, right? And at that time, and mind you, this was over 3.5 years ago now, I had I would say probably at the time, maybe over like $600,000 or so in my business checking account, but I still financed a $54,000. I could have bought 10 or 11 of those just based off of the money I had in my checking account. At the time, the interest rates were about 2%. And I also knew that I could have a better return on capital versus just cashing it out, right? So you have to consider those things. Now, the opposite argument would be, let's say if current interest rates, right? When you look at amortization schedules, your cost of capital is going to be more expensive, right? Currently, the prime rate is 8.5%. So you're going to be paying a higher interest rate versus, let's say, 2 or 3 years ago. So in those cases, it might make sense to maybe use a higher percentage of your own funds or pay down your debts more aggressively to avoid having to pay additional interest, right? So it's all going to vary. So when people say, well, if you have the money, just cash out, I don't always think that's necessarily the best option. Now, it's all going to depend if you have some type of vehicle to deploy your capital, right? So just going back, all right, so this is the Jumpstart loan. Again, the business model is going to be more catered to a prime credit, good personal income, and taxes. Next up, I wanted to go over, let's go over South End Capital. All right. So South End Capital, again, is a division of Stearns Bank, which is a $3 billion direct lender. So again, they are a direct lender and a broker at the same time. So what they pretty much do is they cherry pick the deals that fit their internal underwriting. And then all the other deals, they basically just send out to their third party marketplace. And I can tell you, they're looking more so for bigger deals internally. So let's say if it's usually under $500,000, they're usually going to just send it out to their third party marketplace. But they have a host of different products. So they have what's called fast capital. And this can include term loans, SBA loans, advances, and credit lines. There's no minimum credit score, no collateral. They also have streamlined underwriting. Now, this is one thing I wanted to go over. So we've done videos on South End Capital in the past, but what I wanted to let you guys know is that they recently just modernized their loan origination system, and they use a third-party loan origination system called LendFlow. And I'm not going to lie, LendFlow is pretty interesting because now they're able to streamline the underwriting. So I talk about a lot of these fintechs that are making it much more simple and streamlined for banks and lenders to underwrite. So since we last spoke about them, they now use LendFlow basically this is just embedded loan origination. So from application to decisioning and underwriting, they basically are able to give you sort of an automated, or not, I wouldn't say instant, but a pretty quick decision. Now, in the past, when you went through South End Capital, it would take forever. And a lot of times deals fall through the cracks because they're not, the lenders just aren't as responsive to the borrower. So, a lot of details get missed, or there's just not that level of follow-up. Now with LendFlow, it's a lot more streamlined. Now, just to clarify, LendFlow is not an actual lender. There's just a fintech loan origination. So they have a embedded credit ecosystem that gives companies everything they need to build, embed, and launch credit products. So I just wanted to bring this up because this is what Southend Capital is actually using as a third party to more or less streamline their application process. And lately, we've actually been having a lot of subscribers, a lot of clients getting approved through Southend Capital. They offer a host of different products, lines of credit, business term loans, SBA, equipment, and they even have credit builders now. So right here, I just wanted to highlight. So it says, even if you have no or low credit, you can still qualify for financing without impacting your credit through their flexible programs. So they actually have a couple different credit builder programs for the business. So that includes a credit builder loan, a credit builder card, bill and rent reporting, as well as credit repair. So they pretty much covered a wide range in terms of the different credit profiles, but in general, again, they're going to offer a host of different products. Equipment financing, especially, is one of the things they focus on. So up to $5 million, a minimum of $5K, 0% down on purchases. They also have startups that can apply, nationwide financing. And here's another thing too, they offer dealer and private party sales. So a lot of times equipment financiers may only want you to be able to submit deals from actual dealers instead of private parties. So this is another, game-changing solution. Again, we've been having a lot of approvals recently through Southend Capital. So another great solution out there. Another one that I wanted to go over is called LendSpark, right? Or I'm sorry, LoanSpark. So some of you probably have never heard of LoanSpark. And the reason why is because LoanSpark has somewhat of a different business model, right? So they're more or less B2B to C. So if you go on their website, you can't apply directly to LoanSpark. They pretty much offer business lending as a service or marketplace as a service. So essentially, they partner with, let's say, different accounting firms or payment processors or other financial service providers, and enable them to be able to offer loans to their customer base. So just to kind of give you an example, some of the different products that they offer include, term loans. They offer, business financing, SBA loans. They have equipment leases, commercial real estate. And so for anyone who's interested, again, there's a link that I've pinned in the chat. Anyone want to apply to any of the lenders that we're going over, you could definitely apply. I've dropped links, so definitely check those out. So again, this is not something you can apply for directly, but again, as you guys know, I have a connect for LoanSpark. So this is just the application. Now, again, they just ask for basic information. It is a pre-qualification. And so they will do a soft pull on your personal credit. It's not a hard pull until you actually get back offers. Now, LoanSpark is not a direct lender. They're actually a broker, but I think the term they like to use is embedded financial marketplace, which is basically a fintech enabled loan broker. That's pretty much what it is. So this process you just go through, they have, I believe, close to 200 plus different lenders in their marketplace. And I wanted to go over really quickly some of the different products that they have to offer. So let me just blow this up real quick. All right. So just to start, you have working capital that goes up to 2 million. And again, working capital is going to be shorter term than, let's say, a term loan. So they only go up to 24 months. Now, the difference, a lot of people ask, what's the difference between working capital and a term loan? So with working capital, usually this is when they're going to be making these auto debits from your business checking account, versus a term loan. Usually you're the one who is actually initiating the repayment, right? Versus, with working capital, it's usually a daily, weekly, or monthly, and it's based off of a certain percentage of your revenue. Now, the good part about this is that you only need a 550 minimum FICO, right? They also have payroll financing, which again, up to 500K, no personal guarantee, no collateral, only a minimum of 550. They also have commercial real estate as well. So this could be, apartment buildings, multifamily, self-storage, office, retail, hotels, mixed use, raw land. And so this goes up to 150 million. So a minimum of 150K out to 150 million. Terms from a minimum of 5 years out to 40 years, up to 80% loan to value. Is just a soft pool. You can close within 2 weeks. And credit scores as low as 600 for professional investors. DSCR as low as 0.5 available. So for those who don't know, DSCR stands for debt service coverage ratio. And these types of loans are really popular with real estate investors because the underwriting is not based off of your personal or business financial information. It's going to be based off of that property's ability to service the debt based off of the rental income. So it looks at the ratio between rental income and debt service. So in this case, let's say, for example, rental property brings in $1,200 a month, and the debt service, so that includes principal, interest, taxes, association, is 1,000. So that's a DSCR of 1.2, right? Right here says 0.5. So pretty much what this means is that the property would actually, or the rental income would actually be half of what the debt service is, which I really haven't seen DSCRs that go that low. There are some, let's say, CDFI types of lenders where it might go below 1. So it might be like a 0.9 or 0.8, but 0.5 is pretty low. So this is definitely a good resource for anyone who's looking to get into commercial real estate investing. They also have bridge loans. So these are best for buying properties with a short-term loan so that you can add value, such as rent increases, and then eventually go to permanent financing. And so this is just, again, just short-term real estate financing. This goes up to 50 million. Then you have construction loans. So they also offer construction loans and a host of other, let's see, what else do they have? They have, of course, they have equipment loans. I think this is also probably one of the easier products to qualify for. Equipment up to 20 million, terms out to 10 years. You could also get up to 100% loan to value. So in some cases, you don't have to come out of pocket at all on the equipment financing. It's just a soft pull. They have same day approvals, only a 500 minimum FICO. So again, another thing that they have that's very interesting, they have cannabis funding, right? So I've actually had a couple subscribers reach out who are actually in the cannabis business. And one of the challenges is finding lenders that will actually lend to those types of businesses. So if that fits, your use case, definitely check out LoanSpark. So they have cannabis cash advances, cannabis equipment loans, as well as cannabis real estate loans. Let's see what else they have. They have, they also have loans for businesses located in Canada. So again, they basically offer, pretty much every type of product. And again, this is going to be just exclusively on the business side. All right. Now, the next one I wanted to go over is, let's go over Lendotics, right? So Lendotics, otherwise known as business credit consultants. So this is more along the lines of bank lines and bank lines of credit. Okay. So I wanted to go over real quickly their program guide. And also, let's go over some of the data points too. Let me not gloss over this. So let's, whoops. All right, so let's real quick go over some of these data points, because I did kind of go through this pretty fast. So circling back to Jumpstart. So again, Jumpstart is a direct lender and a broker. The Jumpstart Loan Fund, or the Jumpstart Loan, is going to be their direct lending product, but they also have a broker marketplace. And again, this is just business term loans. They're not lines of credit. Soft pull on Experian. This is going to be full underwriting, taxes. And then in terms of the cost of capital, is going to be relatively lower. All right. And then I wanted to let's go over to, actually, we'll go over this in a second. Let me just copy this. And by the way, anyone who's interested in checking out any of these lenders, I will put the links. So just look in the chat. But going back to Southend Capital, again, a direct lender and a broker, multiple products, soft pull. They use the LendFlow loan origination, and the cost of capital, I would say, is moderate depending on the type of product. Now, they do a lot of these business advances, which, of course, a lot of people don't prefer because it's pretty high cost of capital. So again, it's going to depend. SBA are going to be relatively lower. And then where was I at? Oh, okay. Lendotics. Okay. So if you're into the business lines of credit from commercial banks, right? So I'm not talking about the fintech lines. I'm talking about the actual business lines of credit. So, where was this at? Okay. So BCC, so they coined this, process. So they offer what's called an AI-powered loan qualifying analysis. Now, what's actually pretty interesting about BCC is that they use outcomes data to help with matching you with the right lender, right? And again, they work with relationship bankers at some of the top banks, regional banks like Citizens Bank, Bank of America, Truist, and a lot of the local banks. So they're going to be mostly for bank term loans, lines of credit. So this is not going to be for startups. This is not going to be for people with bad credit. This is not going to be for people with no paperwork, because their process is full docs. And what they do, so you hear a lot about credit card stacking. They're basically helping with loan and line of credit stacking, which is a similar process, but basically there's different considerations because you're going to need more paperwork, right? So again, as it says right here, they have an AI-powered loan qualifying analysis combined with their extensive nationwide bank network, which allows small businesses to swiftly secure bank loans and lines of credit in approximately 5 days. Okay, so some of the advantages, long waiting lines. So they're able to, oh snap, hold up. Sorry, guys. Camera went out. What is it? What happened here? All right. Just bear with me 1 second. I don't know what happened here. Oops. Oh, okay. Sorry about that. Let's start the camera back up. Oops. All right. Sorry, guys. Bear with me 1 second. I don't know what just happened, but just trying to get this camera fixed. All right, there we go. Sorry about that. I think I accidentally hit a button or something. So anyways, so BCC, basically, they do line of credit stacking. So I wanted to really quickly go over some of their programs. All right. So they have a full doc program and they have a low doc program, right? So the low doc minimum credit score, 700 credit score, 3 months of bank statements that can get you approved within 5 business days, up to $250,000. And this may require submission to multiple banks. So in terms of data points, it's going to vary because a lot of you guys know banks pull different credit reporting agencies. But in terms of the soft pull that they do, so before they even take you directly to their relationship managers and relationship or senior banking professionals, they do a soft pull of your credit just to make sure you qualify. And then from there, they're going to collect documents. And then using their AI loan qualification system, they'll see, okay, which banks you qualify for based off of where you might be geographically, the footprint of the organization, and so forth, right? So then they have a full doc. So this is going to be usually going to be for the revolving lines of credit. So again, this includes, again, a minimum 660 FICO score. This says 3, but typically it's 2 years of corporate and personal tax returns, year-to-date profit and loss and balance sheet, business debt schedule, personal financial statement, as well as bank statements. So I talk about this all the time. This is just standard paperwork. And with these docs, they can get up to 5 million plus in funding. So again, they have different programs, a low doc and a full doc. And another thing I wanted to just throw out there is that they also have a consolidation, right, program. So let's say, a lot of these MCA companies where, business owners who may not have all the financials or a good credit might go to these MCAs and take out these high interest types of products. BCC, business credit consultants, they can actually consolidate that into monthly payments, right? And so if anyone has outstanding MCAs, you could definitely check out that. Again, I've dropped a link to all of this, but I highly recommend BCC. We've been getting a lot of clients approved for multiple business lines of credit. So that's BCC. And again, full docs, so they're not going to be for startups or, if you don't have paperwork. The next one I want to go over, since we're, talking about lines of credit, is going to be Bridge by Citi. Okay. So I've done plenty of reviews on this. I would say Bridge is, kind of in the same light as business credit consultants. So for those who don't know, this was a merger between two companies. So previously it was Foro.io, which kind of specialized in like corporate loans, right? So like we're talking about over $1 million up to, $50 million. So really sort of the corporate level. But with this collaboration with Bridge. So Bridge was a platform that was actually developed by Citi. And so they pretty much took the banking connections from Foro.io and then merged it with this digital platform built by Citi to form Bridge. And just to kind of give you some clarity, this is not like Citibank lending, right? So I know it might sound confusing, but the platform was developed by Citi, but as you can see, there's a lot of other regional banks and other sort of community banks you could see that are a part of their lending network. And pretty much what they do is you create what's called an RFP, a request for a proposal. And basically it's just a funding request. Like you tell them, okay, what type of funding you're looking for, whether that's a loan, line of credit, and then they match you, right? So they have a network of different regional banks and CDFI. So this is another difference. So I would say with Bridge, regional banks and CDFIs, not necessarily like Bank of America or Chase or anything like that. They're working more with like regional banks and community development financial institutions. So this is really an untapped, source of funding. Now, what I will say about this, the requirements are a little bit higher. So you need a minimum of 100K in revenue to qualify, US-based businesses only. And going back to the data points, this is going to be full docs. I'm not going to lie. Now you can get an RFP. You can get different responses to your RFP because on the front end, they're not really looking at your financials. But once you actually get connected with a banker, they're going to want a profit and loss statement and 2 years of tax returns, right? As well as a year-to-date profit and loss statement. So again, Citi is not going to be for entry-level businesses. To be quite honest, you're probably going to want at least 2 years time in business. And when I say time in business, I'm really talking about tax years, right? So a lot of people think that, I started my LLC 2 years ago, but I haven't done anything with it. That doesn't really count when it comes to banking, right? Bankers want to look at 2 years of tax returns. So again, this is a pretty new platform, founded in 2021. I know I started working with them last fall when they started to roll out, and they've been making a lot of modifications to their platform. Again, they work with 75 plus lenders nationwide. And, so far they've done over 2 billion in loan volume. So really, really cool platform. Again, I wouldn't recommend this for everyone. If you don't have paperwork, I wouldn't even bother, because it's just going to clog up the system and waste time. If you don't have verifiable documents, this is not going to be for you. So just to kind of compare Bridge versus BCC, they work a little bit different, right? Or kind of the same. They just have a different set of lenders, whereas BCC doesn't really work with CDFIs, whereas Bridge does. So there's not that much overlap. So you could basically apply for both of these different, platforms to focus, I would say, mostly on like larger term loans and lines of credit and get different, results, right? So definitely check them out. Oh yeah, before I get too far ahead of myself, I also wanted to go over Get Loot, right? So Get Loot is a fintech company. Now they offer both working capital as well as lines of credit, right? So they have revenue-based finance, which you can lock up to $250K instant, and this is just going to be based off of cash flow. So there's no hard personal credit check. All you really have to do is hit this apply now button and connect to Plaid. Aside from that, they also have a line of credit, right? I don't know why it says this. You can the line of credit is now open, so you don't have to get on a wait list or anything like that. But let's just real quickly go over the qualifications for each of these products, right? So I'm really going to just focus on the line of credit because I know that's more or less what people would prefer. So again, the line of credit goes up to 250,000. Your credit score is not affected. And again, the line of credit is revolving. So in terms of the qualifications, or let's just say the features of this, you can get a decision in a matter of minutes. And depending on what time of the day you apply, of course, if it's during the normal business hours, this goes up to 250,000, minimum of 5K. In terms of qualifications, all right, so you're going to need at least a minimum of 2 years time in business, minimum revenue of 250,000. Now, here's how they determine this. Now, as I stated, to apply, you have to connect through Plaid. So when you connect through Plaid, they go back 12 months of your banking activity, and based off of the deposits in your bank, that's how they determine the annual revenue, right? So you don't have to do a P&L, you don't have to submit tax returns, nothing like that. It's all going to be based off of your, business banking activity. So one little piece of advice that I would let you guys know about applying for Get Loot is that, let's say you have multiple bank accounts, right? And this is something that I do personally. Let's say any funds that are in excess of what I need to, pay out any business bills or anything like that, I usually just sweep that money over to a money market account, right? Which is earning a higher interest, right, on the money instead of just sitting in a checking account. I know a lot of business owners do that. And so what I would urge you to just do if you're applying for Get Loot, it's not always about how much money you have in your account. Now, that's important, your average daily balance. But more importantly, in this process, it's about the transactions, because again, they're going back 12 months to see what your banking transactions look like. So I'll give you an example. I had a client who applied for Get Loot initially and got denied. So they actually had a business savings account that they connected because they thought, okay, let me show the account with the higher balance, right? Which I think at the time they probably had, about 100,000 or so in their account. And they actually got denied. And the reason why they got denied is because when they're looking back to 12 months, they're not really seeing much activity, right? And there's not as much transaction volume. So in this case, it's not about the actual balance of your business checking account, but rather the transaction activity in your business checking account. So I just wanted to highlight that. Now, other lenders might be different. They might be looking at your average daily balance. They might be looking at your net cash flow. They might be looking at your actual, balance. So in this situation, I would say whatever your main operating account where you have revenue flowing into, that's probably the one that you should connect. And the reason why I say pick that one is because as of right now, there's not an option to add multiple accounts. You could basically only select one account to do the underwriting. So again, this particular client, they resubmitted their application using their main operating account, which didn't have as high a balance. Because again, they're just moving it all to a high yield savings account, business savings account. So it didn't have high balances, but they did get approved for a decent size limit. And again, it's based off of the historical transactions. So that's just one thing I wanted to let you guys know about the underwriting process with Get Loot. And of course, you do need a minimum of a 650. So that's just, something to keep in mind. So let's go so we went over Jumpstart, Get Loot, South End Capital, Lone Spark, Bridge by City, Lendotics. Let's go over LendMate. Okay. So what's really popular right now, because as I said, loan conversions overall are down, whether we're looking at personal or business. I know you see a lot of people saying online, people getting all this funding, which is somewhat true, but I would say there's some caveats to it. So what's really popular right now is going to be 0% business credit card stacking. Okay. So I'll give you guys the scoop on pretty much what's going on. You've probably seen a lot of these ads where people are talking about, I can get you 0% APR business funding. There's probably hundreds of companies who are doing that. And essentially what they're doing, they realize that there's a difference between you applying online directly versus going through a relationship manager at the bank. And there is a difference because in a lot of cases, there's a different underwriting processes. I'll give you an example. The most popular one right now is Chase. So a lot of people don't realize when you apply, let's say online for a Chase card, or let's say you get an invitation in the mail, that's a different process than if you go in branch and apply through a relationship manager. Because what happens when you go online is that there's just automated, credit decision versus when you go in branch, in some cases, depending on the connection you have, that application goes directly to their back office, to their relationship managers who are making the decisions, right? And in some cases, you can actually request what you want your limit to be. And what I've also realized, is that even when you apply, let's say you were to apply online and then also apply in person on the same day, you're going to get an inquiry. You're going to get multiple inquiries. But if you go through a relationship manager, you can actually double dip using the same inquiries. Now, I'll tell you guys this. When you apply for a business credit card with Chase, at least through the relationship manager, they're going to hard pull Experian and TransUnion, right? So they're going to hard pull both. But you can double dip. So you can apply for multiple business credit cards on the same day using one inquiry, right? Or technically it's two inquiries, but you know what I mean? You're only getting hard pulled that initial time, right? So if you apply, let's say you apply for a Chase Business Inc. card through a relationship manager, they're going to hard pull Experian and TransUnion. 10 minutes later, you can apply for another business card through that same relationship manager, and you're not going to get an additional inquiry. That's what I mean by that. However, let's say you went home and you applied online, it's going to be an additional inquiry. And when you actually look at the credit reports, the inquiries actually look slightly different, like the wording of it is slightly different. And that lets you know that it's a different system. And so a lot of people have realized that, right? Where you're getting higher limits, considerably higher limits. It's true. I was skeptical at first, but once I, got more informed about the difference in online automated credit apps versus relationship managers, there's clearly a difference. And that's why there's so many companies popping up where they're charging you 10% to submit your applications directly to a senior relationship manager. And again, that's no different than what, LendMate or LendMate Capital does. And just to keep in mind, this doesn't mean if you have bad credit that if you go through this process, you're going to get approved. Like, you still have to meet the underwriting guidelines. But essentially, what they want to see is that you have at least a 700 credit score. No income documents are required, so you don't have to provide proof of income. And what they're going to do, they're going to soft pull you just to make sure, you qualify before submitting you to a relationship manager. Because as I said, a lot of times people will apply for credit even though they know they don't have a 700, and it's just a waste of time, and it just clogs up the application system. So they do a soft pull, and again, they do also charge 10%. So a 10% success fee. I know what a lot of people think, like, why would I pay that? Why not just apply online? I feel you, right? Like, because again, there's a lot of companies who do that. I'm not knocking anyone who does that, but I'll keep it real with y'all, right? Like, if you go in branch to a Chase branch, and let's say you open up a checking account, a business checking account, and apply for a credit card through that process, you can probably get the same exact results. Like, I know someone who recently did that, and they got $100,000, right, with no prior relationship. They just went into Chase, double dipped, and were able to get $100,000, two $50,000 business credit cards for two separate business entities, right? So again, you can avoid the 10% if you do go in branch. So whether you go through a relationship manager or going in branch, I think you're going to get higher limits for sure versus applying online. Because again, applying online, you have these automated credit decisions, and usually with the relationship manager, they can bypass a lot of that. So again, to each their own. If anyone is interested in applying to LendMate Capital, you could definitely check this out. Again, I've dropped links in the description, or not in the description, but on the spreadsheet. So I pinned that in the chat, so anyone could definitely check it out. But yeah, just keeping it real, like, getting access to a relationship manager is not rocket science. It's not like anyone's gatekeeping any of that information. Like, you can definitely get similar results and avoid the 10% fee. And again, I'm not knocking anyone who, wants to seek out, guidance in submitting the apps, but just to be honest with you guys, like, you can do this yourself. So yeah, that's really what's hot right now, the 0% business credit cards. Cause again, there's no docs. So basically, like I said earlier in the video, you have to have some type of favorable data point. So if you have over a 700 credit score, yeah, you can go to Chase, and they work with, banks besides Chase, US Bank, Elon Financial Services. So when you see a lot of this 0% funding, that's basically what they're doing. They're just submitting your application on your behalf and charging you 10%. So that is what it is. Going down the line. Okay. So we went over that. We went over BCC. Another one I wanted to go over. This one's actually a game changer. Not too many people are talking about this. So let's go over Live Oak Bank. Okay. So for those who don't know, Live Oak, actually, before I get into this, let me just give you guys an intro to Live Oak Bank. Now, Live Oak Bank is actually one of the largest SBA lenders in the country. Let me see. Do I have this open already? No, I don't. So yeah, Live Oak Bank, they're one of the top SBA loans, and they really focus on business banking. But I did want to let you guys know, so they do offer a high yield business savings of 4%. And so this is actually pretty decent. Now, there are a lot of like high yield savings accounts, more so on the personal side, not a whole lot on the business side. So for anyone who is interested in getting a higher, yield on their business savings, you could definitely check them out. I've dropped a link again for anyone to check out. But one thing I will say about Live Oak Bank, in order to apply for any of their products, you do have to be an existing customer. So it's not like you're able to just apply without being having a checking or savings account. So this is definitely a good way in. Just open up a business savings account. But what I really wanted to share is that they now offer what's called Live Oak Express. So this is going to be their in-house funding. Now, again, as I mentioned, Live Oak really focuses on SBA loans. So again, their SBA loans, I believe the minimum is 150. But if you need, let's say, less than $500,000, then you can check out the Live Oak Express. So a couple things about this. Once you actually become a member, open up a check-in or savings account, you can then connect with one of their financing team members, which will help you submit an application. But just to kind of highlight the program, right? So minimum of 10K up to $500,000. They have fixed and variable rates. And again, 10-year notes. I would say this is almost comparable or competitive with unsecured funding source that we went over earlier. Where, it's a 10-year note, they go up to $500,000. Another great thing is that there's no hard personal credit inquiries, as it says right here. So they're not even going to hard pull you. They're just doing a soft pull. This could be used for working capital, business acquisitions, a lot of different uses of this. Now, in terms of the qualifications, you do need to be in business for a minimum of 2 years. And again, they're going to ask for basically all your docs, tax returns, profit and loss, business debt schedule, personal financial statement. They also want a copy of your driver's license, two most recent business bank statements. Oh, one thing I do want to caveat is that your most recent filed business tax return. So not necessarily 2 years, but just your most recent. So we're in 2024. They're going to want to see 2023 taxes and interim financial statements no more than 90 days old. So usually, a year-to-date profit and loss statement would suffice as far as that. So this right here is a game changer. Like no one really talks about this. Live Oak Bank, is a top 10 SBA lender, but now they have what's called Live Oak Express. So it's non-SBA, sort of their in-house financing option. So I just wanted to put that up on your radar. Next up on the list, we're going to be going over Big Think Capital. So Big Think Capital is a broker. Again, they do SBA loans, lines of credit, term loans, kind of similar to some of the other brokers that we went over. Not too much differentiation there. Again, I think they focus more on the SBA loans. Now, they do have lines of credit. Now, one thing I just wanted to differentiate, when you hear lines of credit, especially with a lot of these alternative financing brokers, usually they're not talking about like commercial lines of credit. They're talking about the Fund Box and the Blue Vine and On Deck and Headway Capital, Ideal Financial. Like they're talking about alternative, more higher cost capital fintech lines of credit. Are going to be more cash flow based. Now, if you're looking for like the lower cost of capital, like the bank lines of credit, then I would check out BCC USA, Business Credit Consultants, or Lindotics, and Bridge by Citi, because they're going to actually work with financial institutions versus a lot of these fintech lenders, right? And so that's the difference. A lot of these fintechs say they offer lines of credit, but really what they're talking about is they offer fintech lines of credit, which is not the same. So just a distinction there. 600 minimum credit score, 10K monthly revenue minimum. So that's pretty much it when it comes to big think capital equipment financing. And mind you, some of these brokers are redundant. Like a lot of these brokers might even use the same back end direct lender. So oftentimes, you might find that there's a lot of overlap. That's something that I discovered just in working with a lot of these different companies, is that there tends to be a lot of overlap. But the main distinction, I would say, in terms of getting approved with some of these brokers is going to be their back office. So how responsive are they with handling applications? And, a lot of times some applications fall through the cracks. So, is all going to vary based off of the back end. Next up, I wanted to let's go over First Citizens. Okay. So First Citizens Bank, for those who are not aware, they have working capital business loans. Now, not to confuse this with their regular products. So basically, First Citizens Bank recently acquired a handful of different financial institutions, one which included Citibank. So for those who remember, Citibank was behind the Apple, commercial business financing. So if you wanted like Apple equipment, laptops, desktops, that was through Citibank. So First Citizens Bank actually acquired Citibank, and this program is pretty much, they just rebranded it, but it's separate from their traditional loans and lines of credit. Now, the difference with the working capital business loans is that this is available nationwide versus First Citizens traditional products are only going to be in states where they have a footprint. So again, this is going to be, working capital. So you can use this for inventory purchases, equipment, different working capital needs. And in terms of qualifications, you're going to need to be in good standing in business for at least 1 year, at least $200K in annual revenue, and at least a FICO score of a 600 plus. So again, this is actually a pretty great product. We know a lot of subscribers getting approved for this. And again, it's flexible. And I like the fact that it's nationwide. Now, the reason why I didn't go over First Citizens traditional products is, again, it's going to be limited in scope, but their working capital business loans are a little bit different. Now, again, just to kind of differentiate working capital versus a term loan versus a line of credit. Working capital is whenever you hear working capital, usually that means auto debits from your business checking account, right? That could be weekly, that could be monthly, that could be daily. A term loan is going to be fixed payments on a specific date. And usually as the borrower, you're initiating that repayment. Whereas with working capital, they're just automatically deducting it. Working capital is also going to be much shorter versus a term loan, which, can go out, 10 years, usually on the business side. For unsecured term loans, working capital is usually going to be shorter. Most I usually see is probably out to like 24 months in terms of working capital. Some working capital can go out to 60 months, but it all depends. So just to kind of give you a distinction between those two types of products. So going back, another one I wanted to go over, I recently did an interview, and this is with payroll, right? So payroll is payroll financing. So let me actually go to the website instead of the app. So again, this is going to be for, I would say, more seasoned businesses. So you need at least 25K in monthly revenue and at least 5 employees. This could be W-2 or 1099 contractor. There's no hard personal credit check. And pretty much, what this is a dedicated line of credit for payroll. So you can't use it for any other purpose. It's just exclusively designed for payroll. So let's say you have a payroll where you might have a short-term funding gap. You can use your line of credit to fund your payroll. And this is a game changer because with this, you could pretty much fund your own payroll. And let's say you have something like an ADP or a Gusto. What you would do is you would just, create your payroll. And then what will happen is You can draw on your payroll line of credit. They'll send the money to your business checking account, and then you just run payroll like you usually would, and the money is going to be there in your business bank account to fund your payroll. So this right here is a game changer. Now, again, they're working on some additional products. For right now is going to be more so, again, $25K monthly gross revenue and at least 5 employees. That could be W-2 or 1099 contractors. So again, this right here is a game changer. And also 2 years time in business, and you must also have a payroll software. So if you're paying people under the table, that's not going to work. You have to be running payroll with a payroll software in order to qualify. No hard credit check. So definitely a great product. And again, this is more or less a hidden trade line because they don't report to any business credit reporting agencies. The next one I wanted to go over is Credibly. All right. So Credibly is another, I guess you could say, broker. They offer, again, the lines of credit, the fintech lines of credit. You could also build business credit. So, a lot of their products do report. They go up to 250,000 on the line of credit. In order to qualify, you will need to be in business for at least 6 months, minimum 500 credit score, 15,000 minimum monthly bank deposits, and 3 months of most recent business bank statements. So with Credibly, you don't need tax returns. You don't need P&Ls, nothing like that. This is going to be more or less cash flow based underwriting. So again, very flexible if you don't have the best credit or if you don't have your paperwork in order, but you do have some revenue flowing. As I mentioned, with any business funding, you want to have some type of favorable data point that the lender could actually work with, right? So just going back, I believe we covered all of the lenders. Okay, the last one I wanted to go over, I'm kind of mixed on this. So I did a video on Innovative Lease Solutions, right? And basically, they have equipment financing and working capital. Now, the cool thing about Innovative Lease Services is that up to 150,000, they're not requiring any docs. So this is an option where you can get approved pretty much based off of your business credit profile, right? And they will do a soft pull on your personal credit, right? Which I believe you need a minimum of a 600 let me see, what is it? I have to double check either Experian or Equifax, but they look at PayNet as well. So if you have a built up business credit, and let's say you don't have the high revenue, you can still get equipment and working capital. Now, unfortunately, when I shared this previously, I got an email from the CEO of the company. And basically what I was told was that there was just a rampant amount of fraud applications that were sent through. So I'm pretty certain that they're somewhat inundated with just sorting through applications right now. So that's just one thing to consider. But again, up to 150, no docs. Once you go over 150, but over 150, but less than 250, they just want 3 months of bank statements. And if you go over 250, that's when they're going to want like a profit and loss statement and, bank statements as well. So again, very, very great product. So let's just recap real quick, go over these data points, and then we'll get you out of here. So just to kind of recap, again, these are some of the best financing options in 2024. And again, this is based off of just some of the experience that I've had with a lot of these lenders. So again, Jumpstart Finance, I would say if you're looking for business acquisitions and franchises and you don't want to go the whole SBA route and you have, a 750 or higher and good personal income, this is a good option. You don't need business financials at all. Get Loot is going to be cash flow based. It's a little bit higher cost of capital. You do have to connect through Plaid, but no docs. South End Capital, they're a direct lender as well as a broker. They kind of cherry pick the in-house deals that they fund and ship all the other deals out. But they are working with a new loan origination platform called LendFlow. So the conversion rates lately have been, pretty high with South End Capital. So I actually highly recommend them right now. Then we have Loan Spark. Loan Spark, again, is a B2B2C platform. So you can't apply directly to them. But again, I have a link that you can apply for funding through them. They have pretty much every type of product, and they are a broker or embedded financial or business lending as a service type of platform. Bridge by Citi is, again, going to be mostly term loans, lines of credit. They also do commercial real estate. 2 years minimum time in business, at least $100K in annual revenue. And again, this is going to be full docs. Like, there's no way around it. Tax returns, year-to-date profit and loss statement. Lendotics is going to be similar to Bridge by Citi. And again, there's not much overlap because, again, Bridge by Citi uses regional banks and CDFIs. Lendotics or Business Credit Consultants does not really go the whole CDFI route. They go big banks and I guess regional banks as well. But, the PNCs, the Truist, Citizens Bank, Fifth Third's Bank, BMO Harris. So a lot of those like mid-sized banks and large banks as well, they work with. And they more or less do similar to like the business credit card stacking. They don't do business credit card stacking, but the process is kind of similar where they're routing you directly to their relationship managers. And they've cultivated a lot of these relationships. And I would say with Lendotics, again, they have what's called an AI loan qualifying system. And what's cool about that is that they have outcomes data. So this is information on past customers who are either denied and approved. And they basically are able to compare your data points versus their training set of data. So the training set of data is what's used to train their algorithms, right? So they're looking at, let's say, you apply, you're a trucker, they're going to compare your data points against other previous customers who were either denied and approved based on the same industry, based on maybe the same location, data points such as revenue, credit score, and so forth. So I would say that they almost kind of compete with me directly because I do a lot of that as well. But the limitation that I have is usually I'm using my own data points or data points of clients to really kind of share with you guys, whereas they have hundreds of data points and recent data points as well. So definitely check them out. LendMate Capital is also going to do the relationship manager route when it comes to submitting 0% business credit cards. And mind you, with some of these, you could probably try to do it yourself and avoid the 10% fee. But again, they do provide excellent service and you can definitely check them out. Big Think Capital is another broker. First Citizens Working Capital is what used to be the Citbank Working Capital. They just rebranded it up to, I believe, $250K. You do need to be in business at least 2 years, minimum 600 credit score, and $200K in previous year's gross revenue. You have payroll, which is a dedicated payroll line of credit. You just connect through Plaid, or you can submit bank statements. You do need at least 25K minimum monthly gross revenue. And then Live Oak Bank also more or less full docs, right? They're not going to hard pull you. It's just going to be a soft pull, but otherwise they will look at your financial information. And I would say if you're looking for like a longer term loan, Live Oak Bank would, and you don't want to go to SBA route. They do SBA, but they're, what was this called? This was called the Live Oak Bank. Hold on, let me just pull this up real quick. Sorry, let's go back. Actually, let's go back here. Oh, Live Oak Express. All right, so this is up to 500K. And just another reminder, you do need to be an existing member with them in order to apply, meaning you need either a checking account or savings account of some sort before you can start applying to their loans. Then we have Credibly, which is another broker and Innovative Lease Solutions, which mostly focuses on working capital and equipment loans. So there you have it, guys. I'm going to pin a link in the description of the video for anyone who is interested in checking out any of these business credit funders that we discuss in today's live. All the data points that you need, all the links that you need, any other additional information, whether it's a soft pull, hard pull, what docs you need, and so forth. So I hope this video was helpful. The last thing I will say is that with any of these, you just have to look at, okay, what are your favorable data points? Because at the end of the day, you want to enhance your chances of success when it comes to approvals and being able to get access and leverage, capital to then make some type of cash flow and profit from it and get value out of the deploying that capital. So you want to just look at what your favorable data points. That doesn't mean apply to everything on the list, or every time you see someone post about a bank or a credit card, just run and jump out and apply. You have to really see what favorable data points you have and look at the institution and see, okay, what data points are they really highlighting and how does that fit in with, my overall data points and, what might be my strong suits in terms of the data points I have to offer. So anyways, that's all for today's video. Let me know your comments and questions right down below. And again, link in the description or pin to the chat for anyone who's interested in getting access to the best business credit funders for 2024. That's all for today. Till next time, take it easy and we'll talk to you soon. Peace.